Money is the most important part for most startups. In this video, we are going to learn how to raise money as a startup. We are going to talk with Emil Wargelius, a serial entrepreneur and founder of revelate.app. He went through all of those main stadiums of funding, and he will tell you his own experience and his own view. Before we go to the interview, I would like to summarize the most important learnings from that. Many founders focus on VC funding. VC funding is a very popular investment form for startups. Of course, VC fundings get the most media attention, but they are not the most common and maybe not the best for all startups. And there are a lot of combinations. First of all, you need to reach a certain level. You need to reach a proof of concept and some revenue in order to get VC funding. Ideally, your startup shouldn't only be able to exist if you find fundings from VCs, because that can be very stressful, and even great startups can fail just because they require additional funds. So in the case of our guest, he built first with bootstrapping with his own money and with combinations with loans by the government, where you only have to pay back 10% of the whole loan amount. It is a good idea to start looking for funding programs of your government, but also don't underestimate the power of earning additional revenue as a freelancer, as an employee, or from bigger clients, or also as an upsell to your software solution. So if people are looking for specific features or adjustment or services, you can offer your services or consultation on an hourly basis, because your startup needs money for growing faster, for advertisement. You shouldn't forget how much money you're missing out on compared to your full salary or freelancer revenue if you weren't doing your startup. So each year, maybe you are losing 50,000 euros or 100,000 euros, depending on your job. And if 5 or 10 or 20,000 euros small influx of money can fivefold your growth, your client acquisition, then it could be quite a bargain compared to the salary you are losing out on. And the right timing for searching for investors is when you proved your concept, but before you actually require investors, so before you are in financial trouble, because then it's too urgent and you are in a weaker position, and assume that searching for investors will take quite some time. If you need consultancy in terms of understanding how much money you need for marketing, you can schedule it with me on masterful.info. And now let's move to the interview. Emil, could you tell me a little bit about your experience with those different types of financing?
I'm glad you called me expert. I don't know if I would agree with the expert, but at least I've lived through it, many of them, many of the stages. So I have a couple of different experiences from it. And the reason I found this topic interesting is because my view is that we tend to get a one-sided view of funding a startup. And I think there's many reasons to kind of try to nuance that, especially for first-time founders, that there are more options than just venture funding. When I started thinking of this, I see it as a couple of different ways. High level, you can kind of categorize them as venture capital or risk capital. There's debt financing, bootstrapping, of course. But then there's other types which might be forgotten, and that's really the customer-funded part, which is easy to forget when it's all about bringing in much money and try to scale. And then there are other sides, which I should be honest with you, that I'm not that experienced with, and it's soft funding and it's partnering with the industry, that kind of funding that I have no experience with. But the other ones I've either tried or experienced.
It also has some advantages if you had experience, but you don't consider yourself as an expert, as a consultant, because you were in the trenches. You didn't just tell people what to do and then was watching from outside, the so-called consultant expert kind of, but you can tell us from your own experience. Maybe before we dive deeper into the main financial options, could you tell me a little bit about those alternative options that you mentioned? How does it look like?
Yeah, sure. And I think it's good that you mentioned that, because there's not one correct answer for everyone. And probably not one correct answer for all stages either. All startups will eventually ask themselves, how are we going to fund this? And the answer is going to be different for different companies or different startups, and it's going to be different depending on where you are in the stages. So all or most start with some kind of bootstrapping. There's always an element of bootstrapping because you're going to say no to certain things that you could have done. If you would have your full salary, you're probably going to decrease your salary. You're going to live from loan money from your parents or your wife or whatever. In some part of the startup's life, there's going to be some kind of aspect to the bootstrapping. The downsides with bootstrapping is that you don't share the risk with anyone. You bear it all yourself. On the upside, you will have the sense of urgency all the time. You will wake up every morning and ask yourself, how can I move forward faster? Where can I find customer funds? Where can I find money to make the company grow faster and build company valuation? Because that's really the main goal. It's either build company valuation or come to more revenue. Many times they go hand in hand. But so the bootstrapping is really about keeping that sense of urgency, and that I like.
Bootstrapping, it's just relying on your own revenue stream and building your startup from revenue. So in the beginning, the first months, you probably don't have any revenue and no profit. Maybe you have some savings from the past, and then you try to go to the profit as soon as possible and then to grow from there. And it has, of course, the advantage of not having a very limited time and a much stronger position when you are then decide to search for investors. And it's also, you don't rely on finding investors. What is the difference to Bootstrap to the other versions that you mentioned, customer funding and soft funding?
I just want to add one thing because you brought it to my attention. So if you look at second or third time founders, which have made successful exits, many of them bootstrap a long time before they go to other types of fundings. And I think there is a clear reason for that because you keep your control. And obviously you're full of confidence that you're going to build a successful startup and you want to keep that control. And it's not only about keeping large part of your company for the day when you sell it. It's also about just keeping the control so you can actually steer the company in the direction you want it to go. Soft funding, as I said, I have no experience from it, but it's basically you're getting money from, it could be universities or government to kind of like, we like your idea. It could be green tech or whatever. We want to support your mission in this. And you get, I think EU spends a lot of money on soft funding. So there's huge potential in soft funding. And my type of the company we are progressing with now, it's not really aim for soft funding. So that's why I don't know much about it. You asked about something, yeah, the customer funding, right? There are two different ways of customer funding. One that's more of like industry funding. You team up with a large industry company, for example, and they support you throughout the development cycle. And they are normally also your first and largest customer. The other way of customer funding that's really close to bootstrapping, and that's really finding the customer revenues early on. And if you can do that, that's to me the most beautiful thing you can do. Because that means that you constantly look for the customer value. You're trying to find customers or prospects that are willing to pay for what you're developing. You're going to get quickly to proof points. Is anyone willing to pay for it? You're going to get loads of user feedback and customer feedback. And you're going to constantly have that sense of urgency that, you know, we need to find another customer. We need to find the next customer, etc.
If you compare it with bootstrapping, maybe with customer funding is where you have very few customers that are financing you. And with Bootstrap, it can be also many smaller customers. I think the biggest advantage of bootstrapping is that you are flexible in adjusting your business idea because it rarely works the same business plan that you created in the beginning. After 1 year, 2 years, it's completely different. And probably I can imagine if you have investors, it's much more difficult to change completely because they invested in this business idea and you have to convince them that it's fine. But with bootstrapping, you can do whatever you want. And then when you found the best business idea and it's already starting generating money, then it's also so much easier to get some investors.
I agree. Just to give one more flavor to that, because it's also when you're bootstrapping, you don't have that much time just because you're bootstrapping either. So when you're going to take one of those drastic decisions to change direction, It also means that, you have less runway than you had when you started working on your first idea. So now you might just have 3, 4, 5 months to go before you need to find a paying customer. And for every customer you get on board that starts paying, you might also be more willing to add on risk because you're feeling, okay, so it looks like we actually are getting closer to PMF or product market fit. And that means that I dare to invest even more of my own funds into this because I believe this is going to fly. All of these funding methods, it's not either or. Most companies mix them all, and also during different stages, but also at the same time.
I think one other funding method is working part-time or full-time and then building a startup on the side, or freelancing and generating some additional money that you can reinvest in your business, because you never know how long it will take. It's so difficult to predict, especially if you haven't started a startup yet. Usually, I think people tend to be over optimistic and they don't expect certain issues to arise because they don't know what can arise. But then you suddenly, you spend 3 months with one small issue. Like I had guests on the podcast, they were struggling with the Play Store for several months. They had to resubmit because it was not accepted. So they didn't know that it will happen. And if you only have savings for 6 months, it can be very, very stressful. But if you have a constant revenue stream from your freelancing or job, then it makes it much easier.
That's a very good point. And I was laughing a little bit while you were explaining what you meant, because if all the entrepreneurs out there knew what they were going to go through, I'm not sure we would have started as many companies as we do. So I think this naive way of looking at the world is good.
Oh yeah, I've heard it from very successful entrepreneurs, and they also said, I'm happy I was naive. With my knowledge nowadays, I wouldn't even dare to start.
Yeah, that's a good point. That funding tactic is good you brought it up, because I think it's a great way of doing it, and especially if you're, let's say, a developer. I think it's easy to have side gigs. It's more difficult with my background to consult on the side. I think for me, it's just, I started digging and trying and doing some market research, started talking to friends that could be customers. And as soon as I decided, this is what we're going to try to build, and I think this is what the market needs, it was just 100% for me. I just shifted my focus fully. But if I could, I think there's a good point in trying to keep it as a side gig for a while. But then sooner or later, you're going to have to be 100% focused. I had a mentor at my first real work job, and he told me, you need to decide now, Emil, because either you're going to be a B player on both teams and you need to decide to be an A player in one of the teams. That's a good insight.
Yeah, entrepreneurship, it requires so much effort that it's difficult to sustain it just with having 10, 20 hours a week. You are already competing against whole teams of people. And if you are not even able to have a full time of yourself, then it will be really tough. But yeah, it's always a balance, because it's better to start somewhere suboptimally than not to start at all.
I fully agree. And if that means that you kind of de-risk whatever you're doing, if that's what's needed, which I think is often the case, but if that's what's needed for you to actually start your business, I think, then do it. It's better that you started than not started.
And I think it's also important to be realistic about how much you can actually achieve. So there are business ideas that are more complex and require more resources. And there are business ideas that are easier to implement. For example, all those business ideas with networking effect, where you have Airbnb hosts and guests, or we had a guest on the podcast about dating app, for example. That's really, really tough because you cannot grow it slowly. So it's not very well made for solopreneurs and especially part-time entrepreneurs. You need investors. So it's probably better just to search for investors. And if you don't find them, then to pivot to a much simpler business. Also, I think B2C oftentimes require investments because you need to invest so much money into marketing, and people underestimate how much actually profit you generate after you remove the client acquisition costs. They look at big competitors and say, they are asking so much money, 20 euros per month. I believe I can do it for 5 euros per month. But what happens is the competitor has 3 times more to acquire the clients, kind of, and you are struggling with that.
Yeah, that's a very good point. Now we're a little bit off topic, but it's so interesting because that's really, I think, why a lot of the investors ponder on the LTV. Because if you can bring the lifetime value of the customer up, you can also bring the CAC up. You don't want to do it just to do it, but it means that you can bring on more customers.
Absolutely, yeah. That's another very important thing. Lifetime value is not just the first initial investment. I had many clients as a marketing agency who were disappointed about the high client acquisition costs, but they can earn for 1 year, 2 years from that particular client. So you have to take that into consideration. And if you create a really great product where people stay there, then you can outperform the competitors in the long run. But of course, you have to invest like similar probably amount into client acquisition in the beginning. You have to be realistic about that, which is also connected to investment. I think many founders, they underestimate how much actually it costs to acquire each client. And they start with almost no budget. And then they are surprised that nothing happened after 1 or 2 years.
No, I agree. And if you can keep the retention rate up, I mean, since we're building a SaaS company, if you can keep the retention rate up, that's the silver bullet. That's really stage 2, because the first stage, if we talk about customer funding, the first stage now is just bringing the customers on and get them to pay. But then in year 2, that's when it gets interesting in looking at the retention rate, because if we can get to keep 95% of them, well, then that's a lot of money saved on the customer acquisition side.
Yeah, I think you reach that by really understanding your target audience and talking with them and giving really amazing support. And you have to use your agility to your advantage, and you can adjust the product according to your users, and to be very, very specialized in just catering to these particular users. Otherwise, it's very difficult to compete with companies that have 10 times, 100 times more resources than you.
Yeah, 100%. I just came to think of, we just stole our first client from a giant. And it's really about that. It's really about being agile and being there for that specific customer and showing them that we really care about them. Our products, they're on par, but we can support you with other things.
There is also another variation of funding. You can offer a main software solution, and then you can offer customization services on top of that. So for example, I've seen WordPress templates or plugins, and if people wanted to adjust it to their needs, then you can hire the company who created those things and you pay them per hour, which is also easier to generate money from each client.
Yeah, it's I agree. And another good aspect of that is that you don't give away too much for free. So you make it clear to the customer that we're available for you and we can do these customizations, but we're also going to charge you for it because we're professionals. So it's going to send you some signals that you know what you're doing and that you can charge customers for doing it. But it also means that the customer is going to be a little bit more thoughtful of what they are asking for.
It's easy to get into this cycle of whenever the client wants a feature, just to implement it.
Yeah, exactly.
And the disadvantage is you are very busy with just building those features, which might not be interesting for other customers. And you can make your software solution or your product much more complicated because each feature, it requires also maintenance. It requires usability on the interface so people can find it. And if you say, okay, those are my core features, and if maybe many people on a regular basis, many customers tell you, I want this feature, then you can implement that. But if it's only one person, then it's better to give it as an individual service solution. People who are listening to that might have a concern that this approach is not scalable. Important thing, I would say, as an entrepreneur to understand, there are different stages of your startup. And even if you want to build $1 billion startup, if you don't have a lot of funding from investors. In the beginning, it's not about creating a scalable business. It's about surviving, because 90 something percent of startups in this stage don't even survive the first couple of years. So if you survive, not only survive, but with some profits and revenue where you can live from that after a couple of years, then you can really replace the less scalable profits with scalable
Yes,
revenues.
and consultancy hours, it's a good example of that because it brings you revenue. Long term, you might not want to do too much of it, but then you can shift to product revenue and decrease the consultancy revenue. Two variations of this is, so I just met with one of Sweden's largest telecom companies yesterday. And we had a really good meeting. We had a product that they could benefit from, but we ended the meeting with talking about, can we meet in this? I mean, they're huge, we're small. We need to somehow find a way to work together. And I think that's, as an early stage startup, you start looking at these really big companies and you hope to get them as a client. That's not necessarily good because it's going to take long to actually sell to them. It's going to take very long to onboard them. And they're going to have so many requirements that, as you said, it might not be a fit for the rest of the market. And I think it's important there to remember that just because the client says they want something or need something, you need to check it with the rest of the market. Like, is this something that other customers are going to need? But also, question one more time. Say okay, so if we would do this, how much would it benefit for you? How much more would you be willing to pay, etc.? Because once they start thinking, it's like, now that you say it might not be that important. And you spend 2 months to develop that feature. That's very dangerous.
We had the same experience with one of our clients when we created our SaaS many years ago. This client brainstormed so many ideas and we started implementing because we were so motivated. Wow, we have finally a client and we want to make him as happy as possible. And if we create more features, it will be more much better, will stand out to competition. And then we ended up with a feature creep. So many features and everything is half baked. You have to invest a lot of time to really make it smooth. And then at some point we went to a corner where we just said, okay, you know what? We have to start from scratch. So it was a huge bump in our entrepreneurial road. I can just recommend, not to just start implementing those features.
No, exactly. And I've been on the acquiring side in larger projects as well. If you source the product, once you start asking for a lot of features or bespoke development, etc., you as a customer also kind of dig your own grave because that's going to be really difficult for the providing company to make sure that you have the latest version of the product. Every time you're going to launch a new product, you're going to have to do workarounds for their product, etc. You really just want to do as much just standard product as possible. And most companies, especially at least in our business, I would say, can live with and thrive with the standard product. They don't need those extra features that they think they need.
Absolutely. We covered the topic of bootstrapping quite a lot with different variations. Before we go to investment, let's cover the loans. That sounds a bit scary, to be honest.
Well, that's almost my favorite part.
Oh, wow.
It came to be because for first-time founders, it's so easy to think like it's the big rounds. That's all we're going to aim for, the big VC rounds, because that's what gets media coverage. So you think that all the successful startups have done huge rounds, but that's not the truth. And you have a lot of downsides with that too. Again, it depends on, the phase you're in or what company you're building, etc. But if you manage to do it like some bootstrapping, some customer funding, and add on debt financing, then you keep full control of your company. Mm-hmm. And there are so many, banks won't give loans to startups, but there are so many alternatives to it. So there are in Sweden, and I'm sure in most other, at least European countries, there are so many ways of loaning money to your business with the governmental support. The Loaning Institute has governmental support to do these kind of loans and investments. And it's normally, when we took our first loan, I think we had a personal responsibility of 10% of that loan, which is really small amount. And so you get this loan and you get some time to actually build and meet customers, etc. And you keep control of your company. So to me, debt financing is such a good way of keeping the round size smaller. And once you grow, there are companies like, there's a Swedish company called Gillian, and there's this Founders Path, I think, in the US, like just examples of they're providing bigger loans if you matured a little bit. It's just an advice early stage that it doesn't have to be large VC funding.
That's, of course, is less scary if you have some kind of funding program from the government and it's part loan, part government funds. It's interesting to see that there is not black and white so far with the other options. It's always kind of a mix of something. So I would encourage our audience who wants to finance their startup just to check for possibilities, which kind of funding programs are offered in their region, in their country. I know, for example, in Austria, they offer 10,000 euros funding if you want to make something technical improvements, which I think half of it is a gift and half of it you have to pay off, something like that. So suddenly it can bring you forward. And in worst case scenario, you go work and you can pay off pretty quickly. What many founders, and including myself, don't realize, every year you are doing your startup, you're working on your startup, you're missing out on your full-time salary. So it's not about like, I can live on minimum living standard and I can save a lot of money and I do a lot of things myself in the startup. But you are missing out maybe on 50, 60, 100,000 euros every single year. So compared to that, if you can borrow some money, 10, 20,000 euros, and then in addition to that, the government gives you the same amount or something, and you can increase the speed of your startup fivefold because you suddenly can promote it, not just with social media manually, but also with ads in bigger scale. You maybe can hire someone who can assist you. I think in many cases, it can be really worth it.
I fully agree. And I mean, this missing out on your salary, that's really part of the bootstrapping as well. So it's going to be many years before you actually start taking the salary that you probably should have earned. There's a social aspect to that too. You have friends, maybe you're early in your career, you see your friends climb the career ladder. They might buy a boat or, they have money to spend. And you as an entrepreneur might not because you've made those choices. Hopefully you have a big payday further down the road, but that's not for sure. And so that's really why every entrepreneur is a role model to me, that they are willing to take that both financial but also social risk.
And probably even those founders who are getting investors' money, in the beginning, they are earning less than they would earn as a salary. So if you want to get rich quick, probably entrepreneurship is not for you.
No, it's not. Definitely not. No, then you should probably go into sales or consultancy or corporate finance or something like that. But that doesn't suit everyone either. No, I think, and I mean, if you're raising capital from a VC firm, they're going to look at your cash flow and your burn rate. They're not going to be happy if you have too much salary paid either. So for sure, yeah, it's going to be a while before. I mean, and I don't feel comfortable paying myself a lot of money until my customers tell me that I earned it. Regardless how the money comes into the company, you should be careful and have full respect for those money.
Let's talk about the right timing of starting searching for investors. There are also different types of investors, business angels, maybe accelerator programs, and then VCs, with high amounts. I'm wondering, when is the wrong time to start searching for investors?
The most correct answer to that is when you need the money, because that's when you're getting desperate. It always takes longer than you think, unless you're lovable or something like that. Then it goes really fast. But most companies are not lovable. So
what do you mean with lovable?
That's a Swedish. Yeah, there's the startup. They're an AI company. They're an AI agent for product teams. Basically, you can develop websites, etc., without coding, more prompting. And they've got a lot of.
There are some exceptions for that, but usually,
normally, that's not the standard case. So normally you need to meet the investors, you need to meet them many times, and you need to convince them that you're the right team with the right product, with the right timing, and you have the right kind of progress and market traction, etc. So it takes time. If you're desperate, you're not going to get it on the terms that you would want. So plan it and be prepared that it takes time, and be prepared that as soon as you close the round, you have a couple of months to work on your product and your company, and then it's time to start working again on raising capital. We've been only in the really early stage capital raising, and we're in the middle of a round right now. But so this is based on my experiences that I have.
Do you think it's possible to get investors with just a PowerPoint presentation?
Yes, you can. The climate in the market decides that. I think maybe 3, 4, 5 years ago, you could do it more easily. Then it's been really tough times. And now I think some teams with a proven track record and a clear idea can do it now because there are VCs, angels that want to put a bet into AI. But then you really, I don't think you can do it. Just raise your hand and say like, hey, I have a PowerPoint here. Let's do it, because money is too expensive. But if you have a strong track record that can prove that you've built products and companies previously, there are VCs out there that are ready to spend those money.
So it's not a good news for first-time founders.
I suppose not. But the good news thing is, if you take you and your company through these kind of tougher times, you're going to be a hell of a lot stronger on the other side. So you have to see it that way.
Nowadays, it's better to focus on bootstrapping and building some traction. And then when you realize, okay, now we proved how much the customer lifetime value is, we proved that it works, that people are staying, they stay for at least 1 year, then you have much bigger potential to find investors, because otherwise you will be just busy searching for investors. And while you're doing that, you cannot focus so much on your business. If your business is already a bit stable, then you can just look out, and for you don't care if you find an investor in 1 month or in a couple of years. You can sustain your business. And I guess for different investors, there is also different vision important. So for VCs, you have to convince them that you have the potential to grow to very big level, to big company. And probably for business angels and for certain accelerators, it's probably less important.
I think so too. So the big VCs, they look for the next, I'm just using Swedish examples here, but the next Spotify. But the truth is that most SaaS companies and other tech companies, they have a bright future, but it might not be, world heritage. But I think the advice you gave are valid either way, because you always, even if you have an easy way raising money, if you have more traction, you're going to have a higher valuation. So I would say the good thing with the tough climate now is that we are forced to put the customer first and the development of the company and product offer, and make sure we can actually bring in revenue. Because if you forget that, then you're going to have difficult times raising the next round, etc. And you might even need to lower your valuation, and that's always tough times. One of the main objectives with the round we're in the middle of right now is to get, let's say we get 15 months runway. At the end of those 15 months, I think we're going to need another round to expand to Europe and the US. But I want to be able to choose if it's the right timing. So we can go cash flow neutral in case we want, and wait 2, 3, 4, 5, 6 months in case the climate is wrong or we don't find the right investors. So we don't need to rush into and are forced into the next round.
I see some of my friends and colleagues who are sustaining their startup from one investment round to another, and it looks very stressful for me. And they know if they don't find the next round, even though they are growing like crazy or pretty good, they have to shut down because it's all built on this momentum of finding the next round. I guess it's also not for everyone to have this kind of lifestyle. So it's better to have your approach with like you are doing with your startup. If you get the investors, then you can grow even further. But if you don't, you can stay constant and build it in a slower pace.
Yeah. And that's easy to say. But that's how we want to do it. And I really hope we can manage to do it that way. We'll need to talk again in 15 months and I'll let you know how we ended up.
Can you tell me the story of how you got your first investors?
Yes, we had 3 offers and decided to, and we were actually going to sign, we had general meeting in our small company just to get all the formalities in place and get all the documents signed. And one of my co-founders said, let me just talk to one more investor over here and see if they're interested. And they were. They're an investor, part of an accelerator program. They actually, I think we closed that round in 3 or 4 days. I think we started talking to them on Thursday.
Wow.
We had the first interview on Friday. On Monday, we met again just in person. And then Tuesday, we basically signed. But that was a lot of work ahead of that. We were lucky that we had more options than one, because I think either option would have been a good option, but it always feels better if you can pick and choose, because that means that you weren't forced into something that we could choose between. In the end, it was two, because we had said no to another one earlier, but that made us feel more comfortable. So yes.
Did the other investors understand that there is competition, that you have other options?
Yes and no. So I was a bit surprised, because my wife usually says you never meet, I think this is a common saying, but you never only meet once in business. When we talk to customers and prospects, we make sure to always have a good relation, because even though they might not be our customer today, they might come back in a couple of months, or they might be a reference to another customer, etc. But some of these investors, they just went silent when we told them that we decided to go with another another investor. I don't know if they got mad or so, but they didn't even respond to my email when I explained what we decided to do, and I tried to call them. That said, nowadays, when we're in the second round now, we're talking to them again. And they're super, nice, and we have a good relationship. But I was still a little bit surprised. It was like they were offended.
Wow. I mean, it should be common to lose deals. And why didn't you accept both investors and you would have double as much money?
Their terms wouldn't allow that.
Yes.
So we had to choose one or the other. And also, they both provided similar amount of money. That was the right amount for us at that time.
Mm-hmm.
But that said, I mean, we're open to both of those investors for this round as well. So hopefully we get to accept them this time.
Why do you think they accepted your deal so fast, besides the preparation of the documents and requirements?
Yes, that's a good question. So all the formalities, all the pitch decks, all the documents, legal documents, etc., they were all in place, because that takes a lot of time to prepare. So obviously we had all that prepared, because we were just going to sign for the other investor. But I think they looked at the team and they looked at the product. So when they saw that we were serial entrepreneurs, many of us in the founder team, they saw that we had a product in place, we had a couple of paying customers, and they too regarded it as quite a fast build. It should be, more of a market case almost than a tech case. I think they just saw, this is a very sales and customer oriented team with a product in place with paying customers. Let's take the bet. So I think they saw it as kind of a low risk. It's always high risk, but, compared to others.
What was the point where you decided to start searching for investors? What were the reasons for that?
The reason I told you is the wrong reason. We needed money. We were really out of cash. So we had basically, one of the founders said flat out, like, I can't bootstrap anymore. We need investments in X months. We had some debt financing from ALMI, which is a Swedish, this government supported loan agency or loan institute, but we were running short on those money too. So it was really time for us if we wanted to keep building the product, we needed funding, basically. And in this case, we also got a lot of support from marketing coaches, sales coaches, and a very strong network. So yeah, this was the right timing with the right investor.
What were the first steps in your search for investors?
Just mapping them all out and understanding which are for us. So now that we have more of an established network with investors around us, I understand that many of them want to meet with you and they want to keep in touch for later rounds. But as an entrepreneur, you need to know who's going to be of interest in this round and who's going to be later. Because I spent so much time on investors that never would have been a fit for us. They would never invest in us at this stage. So trying to map that out fast and understand where to spend your time, really like a customer ICP. Where do you want to spend your time? With the clients that might say yes, and try to get fast no's. I heard someone say a quick no is the second best answer. And I think that goes for investors as well, because you need to spend your time with investors that are going to support you.
Yes. Where were you searching for them? On LinkedIn or some special databases?
Yeah, so there are some news, like startup focused news letters and news agencies in Sweden, which provide these lists every once in a while. The problem with them is that they are very hammered with startups, sending them emails and pitches, etc. So you really need to find a couple of investors where you get some airtime with them to talk to them and tell them what you're providing and what you're looking for. and they can normally help you to find the next investor. Like, okay, this is an interesting case. I know 2 angels that might be interested. Here they are, and they make a warm introduction. So I think that's the best way to start, because these lists with, the 400 most active angels in Sweden, when you get to the bottom 200, they're not very active anymore. So yeah, it's difficult to know where to start, but getting introductions is the best way, I would say.
How important is it that they are local, that they are in the same country?
Oh, for VCs, I don't think it's very important. It could even be a downside, because one of the investors we're talking to, they are from middle of Europe, which I think is great, because that's where we want to go eventually. It can even be a downside. When it comes to angels, I think it's an upside, because it's easy to meet with them. You want a personal connection with them. Otherwise, I wouldn't spend too much time on where they are located.
And speaking of the difference between business angels and VCs, from my understanding, probably in the early stage, it's easier to get, or better to search for business angels. They don't give you so much money, but they can give you so much help with their network and advice. And they are probably also a good stepping stone to find bigger investors like VCs.
Yeah, I agree. And it goes a lot faster to close those angel rounds normally. We have a couple of sister companies. They actually got an investment from an angel just by one phone call. He was like, I fully understand what you're doing. This is great. Here's the check, basically.
Wow.
So yeah, it can go much faster. And one advice there is that business angels normally have a really big network of both investors, but also portfolio companies and other companies. So ask for customer references. It's so strong when an angel says, like, okay, you should meet with this company. They might want your product. And that company will always say yes to a meeting. And you will get feedback and potentially also a customer. And you're showing the angel that you want to do business, which angels like.
Wow, that's a really good tip. You can even find customers with business angels. How did your business changed after you got this investment?
Not much, actually. We're still on the same track. If we're getting what we can do once we get this round closed and the money on the bank is that we can start planning a little bit longer. We can start developing some product features which we know the customers want, but we haven't had the time to spend money on, because right now it's really just about, everything we develop needs to bring revenue, basically. But so there are a couple of features, and also obviously also the AI case needs to be developed on our side too, but we just haven't had the time to put all those resources in there yet.
Amazing. Emil, do you have some last words to our audience? Maybe you have some advice, or maybe you want them to do something like connecting on LinkedIn?
Yeah, well, obviously connect on LinkedIn. That's always great. But if I want to give you one advice, especially to early stage founders and first time founders, is map the full funding landscape that suits your business and decide on a tactic, and don't go in there with just one mission. Map the whole landscape and decide what's best for you in this stage.
Amazing. It was very, very helpful, I think, Emil. For me, it was very insightful, but I think for founders, it will be even more interesting. Thank you so much. And yeah, see you another time.
Thank you so much.